This is going out there. It's August 10th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. So we have interest rates down, the dollar down, stocks surging. Why? Because we finally got a positive CPI reading. Consumer Price Index. That's the gauge the Fed looks at, the world looks at to determine where inflation is going, even though it's a BS gauge, and we know that. It's been revised numerous times. We know that rental income continues, or rents continue to go higher and higher. That accounts for 30% of this index. However, finally, it showed positive signs that inflation is moderating. Where it rose 8.5% year over year, that was less than 8.7% that was expected. With the core, which strips out food and energy, that came in flat, under the 0.2% increase that was expected. Again, that's year over year. But more importantly, month over month, which is what the Fed is really focusing on, both CPI and core rose less than expected. I'm going to throw some numbers, figures at you. I want you to pay attention. You know, some of you listeners right now saying, Frank, you know what? We're talking about inflation at 8.5%. We're celebrating this. The market's going higher. Most prices still high. They're not going to take those price hikes back. At least some of them aren't. Until they see less demand, they're going to be forced to lower the prices. And sure, gasoline prices are at, what, $3.75, $3.80 on average, but they were $3 a year ago. Food prices are still very high. Rent's still high. Electricity's still high. And you're saying, hell, almost all my bills that I'm paying are still much higher than they were a year ago. And you know what? You're right. So before you say, Frank, you're an idiot to say this is positive. It's still going higher. I get it. I pay my bills too. I like the Fed who doesn't get it. But from a market perspective, or how this is going to impact your portfolio, whether it's personal portfolio, retirement portfolio, okay, whatever it is. The reason why most of you listen to this podcast, this is great news. Because the first time the CPI shows that inflation is moderating this year, basically since the Fed started aggressively raising rates. And it's supposed to happen 4 months ago, 3 months ago, 2 months ago, last month, and it didn't happen. Finally, with this reading, it happened. I thought it would happen last month. So what does this mean? It means that the Fed going forward is likely going to slow the rate of interest rate increases, which basically puts a floor on the market. And likely means that we already bottomed in early July. For now, it's one reading. We'll talk more about this in a second, but it's definitely a positive. Now, it also removes the negative headlines from other Fed presidents like Cleveland Fed President Loretta Mesta, St. Louis Fed President James Bullard, one of my favorites, Richmond Fed President Tom Barkin, and San Francisco Fed President Mary Daly, who in the past few weeks publicly said that rates need to go significantly higher because they did not see any signs of inflation moderating. I had a massive rant on this and shows you why there's such a disconnect between what the Fed does. I don't know who they hang out with. I don't know if they lock them all in a room and they're not allowed to talk to somebody. I don't know if they never pay their bills. Maybe they're just filthy rich. But for them not to see what is going on, that inflation is moderating in so many places, was crazy. And some of them suggested that we should be at 4% in the Fed funds rate. This year, we're only at 2.5%. This year. Another 1.5% rise after being from 0 to 2.5%. Now they want it to be 4%, saying they're not seeing any evidence at all, even though it was in plain sight over the past 6 weeks, 7 weeks. Copper down 40%, lumber got cut in half, oil was 130, it's 90. Gasoline prices down over 25%. Mortgage demand falling off a cliff. Supply chains easing, showing that demand is slowing. They're saying that demand is slowing. There's actually container ships that are staying longer and longer on these lots because demand is slowing. Retailers, Walmart, Target, across the board, saying inventory levels are incredibly high, which means they're going to have to sell these items at steep discounts, which will take months to do so, right? That's deflationary. These are signs. I'm not saying that it's great. I'm not saying inflation's not here. I'm not saying price. But from a market perspective, this is the most important thing. You have to focus on the Fed. Don't fight the Fed. Don't go pay. That's why stocks, it was a buy the dip for 10, 11, 12 years. It's a credit crisis. Buy the dip, buy the dip, buy the dip, buy the dip, because the Fed was keeping rates low. They were forcing rates low. They kept them low, and they were also buying bonds. So now when you raise rates, it's totally different. But when you're looking at inflation, is clearly moderating in some places, and that's what we need to see. But these Fed presidents that I just named, they were saying this publicly. This is over the past few weeks. And this flies in the face of what Powell, the Fed chair, is saying. Because you didn't hear him say 4% at all. That wasn't on the table. He didn't say that. But that confuses the hell out of the markets. It confused the hell out of investors, the institutions on what to do. Because you're contradicting, basically, I'm not going to say it's his boss, sound like he can fire, but he's the chair. But I'm quoting here. This is what Powell said. This is 6 weeks ago. He told Congress the pace of interest rate increase will continue to depend on the incoming data and evolving outlook for the economy. He didn't say inflation is still wildly out of control and we got to raise rates incredibly. And all these guys have said this, and these people have said this, Fed presidents, were all completely dovish pre-2022. It's transitory. We're fine. We're fine. We're fine. That's what they said. Now, it's great that they're saying this because you just have to do the opposite of what they do, and usually you're going to work out perfectly fine. But these Fed presidents, they need to be muzzled. Put tape over their mouth. Shut them up. I mean, no idea why these guys are allowed to speak publicly and contradict their chair, which is Powell, which makes predicting what the Fed is going to do very, very difficult. And I've said this a million times over the past 15 years I've been doing this podcast. Uncertainty is the death of stocks. It's the death of equities. It's like me talking to my shareholders about my company after my quarter, saying, yes, we're seeing growth. I expect to be strong over the next 12 months, probably going to do some hiring. And then members of my board, who are not even like the COO, whatever, right? I could be chair, whatever. They start speaking all over the world at conferences saying, no, Curzio Research, they're not going to grow that fast. Inflation's going to hurt us, so we got to be careful. Think about that. I mean, if you contradict what the boss says publicly, whatever happens behind closed doors or whatever, you have disagreements, whatever, that's what you have partners for, right? But publicly, you all have to be on the same page. If not, that's grounds for being fired if you're going against your boss, basically. And they can't be fired, right? They're voted in. But think about that, how crazy it is. I remember when it comes to the Fed, especially since 2008 and 2009, and those have been following even earlier, again, but from 2008, 2009, they made it policy to be more transparent, to tell the public ahead of time, right? Testifying before Congress, you're seeing it all over TV now. Whatever really was broadcasted on CNBC, where you had the Fed chairman testifying in front of Congress. Now it's a very big deal because they're more transparent. They tell you what it plans on doing, the Fed, in regard to interest rates, their balance sheet over the next 3 to 6 months. This way, there's no surprises. Because what happens when we see a surprise move by the Fed, the most powerful organization in the world, where if they get it wrong, the entire global economy falls into recession, people lose their jobs, people die if they get it wrong. We see the markets, for 11 to 12 weeks. Right? This happened in November, where they totally transitory, said, holy shit, we are so wrong. Inflation's out of control, and we're going to have to raise rates super aggressively over the next 12 months to try to control it and stop. We don't know what we're doing. And what happened? The markets crashed. Nasdaq fell 30%. Many stocks 60, 70, 80% because massive deleveraging. Holy cow. You're not just like slowly raising rates. You're talking about going from 0 to 2.5%, 3% immediately. I remember in November with Goldman, you look at those reports. Oh, we're going to be at 1% at the end of this year. Oh, it's going to be 1.5%, 2%. Then all of a sudden it's 3.5%. Whoa. I mean, this is a major factor. Going from 0 to 2.5 is like you losing a football game 80-0. That doesn't happen in that time period. You have to let it filter through, and it's filtering through. It's not like, wow, we're seeing prices decline. All of a sudden, they're going to go high. You're seeing it factor in. It's getting harder to borrow money. You're seeing things shrink. Not everything, of course. I'm not here saying, wow, we're good. That's it. Everything's so. No, but right now, based on the data today, which we've been saying, I hate saying that what we've been saying. It sounds arrogant because, again, we're wrong on some things, and I'll go cover that in a minute. One sector that I thought was a buy, it's a screaming buy now. But there's clear evidence that it's working. And the reason why you could see, I've never seen it work this fast. We're in a 6-week period. Boom. Holy cow. Copper prices. Look at wheat prices. Look at corn prices. Wow. Energy, 130. Everybody bullish. It's 90. Gasoline prices are down. Tremendously, they're down. Yes, they're still up. 20% year over year, 25%. But they're down incredibly. But the Fed, you don't want any surprises. That's why they come out and tell you, hey, this is what we're going to do. But when you have Fed governors going everywhere, and it's getting picked up by you look at Bloomberg, you look at briefing.com, you look at all these services, whether it's, like all these news feeds are picking up what these governors are saying. And they're even mentioned on CNBC. Wow, they expect 4% rates. 4% rates. If we go to 4%, we have another 25% downside here. There's no way they should go to 4%. That would destroy the market in 2023. It would destroy it. And that's why we rose so much off July. The market usually knows ahead of time what's going to happen. Don't fight the markets. And the markets have been rising, and now look where we are. Now, this is just one positive reading. Just one. So the point is, when you look at the Fed, September's their next meeting. They were supposed to raise 50, 75. It was kind of split. 75 basis point hike in September. 75 basis point hike in September is now off the table. Market expects a 50 basis point hike. Okay, that's okay. But there's mounting evidence that the current rate hikes are starting to work, which means the Fed is likely, after that rate hike, they're going to come out and either say, we're not going to raise rates, or they're going to be dovish, which they haven't been in a while, which crushes markets. And I'm going to say, you know what? Wait and see. Things look okay. It's heading in the right directions. We see what's going on. It's a soft landing. May have bottomed. You could argue what's the definition of recession since we're changing that now. 2 straight quarters of negative GDP. But maybe we don't fall into recession. It's a softer landing. Unemployment stays pretty strong. But we're seeing inflation moderate in so many different things. Not everything, not rent, not really food. But in a lot of things, especially energy, which impacts all of us. And we see that. I see that. It was costing like $110 to fill up my tank. Now it's like $90. It's a big difference, especially for me since, we're moving and we're driving like crazy back and forth more than probably anyone that drives in the country right now, other than truck drivers. But that's the big theme. That's why stocks are going up so much. So when you're looking at it there's a difference between personal, there's a difference between what the markets want to see and what your stocks want to see. And they overshot completely. And now you're seeing them catch up. So the Fed right now, if we come out, you're looking at August and you say, well, what's going to happen if inflation starts rising again? And it could. I'm not saying it can't. But if you're looking at the data right now, it's probably going to come in at a much better reading than even this month. If we continue on this pace to just stay this way, because energy prices are down over 10% just this month. And this is the data that's being included in the next reading. So let's see what happens. So this is going to be the August data is going to be reported right now, a month from now, September 10th. And then you have the Fed that's going to come out and they're going to look at that and the month and this month's reading and say, okay, we're moderating. But even when you're looking into next quarter, we're still seeing inflation moderate. But more importantly, we're seeing supply chains ease because you don't have this massive demand. And that's very, very important where companies can be more predictable. Whether it's car companies, chip companies, any electric company that uses a chip could be more predictable now. And that's why you're seeing companies like Apple really surge. Seeing other names in the chip sector, technology surge. But looking at the numbers right now, the Dow today is up 1.5%, doing this around 11:30. That could change. Who knows when news comes out these days? But you're seeing across the board, you're short, and there's net shorts have been building these positions. Building these positions. I'll be surprised if maybe, I don't know, you can't predict what the market's going to do. I like to throw it out there, and if I'm wrong, I'll say I'm wrong. But the shorts here, there's a lot of people short this market right now saying we came back too fast, and you might say, that's right. Because the S&P 500 is now at 15% from its lows, and we say it's lows basically since July 1st. The Nasdaq's up 20% from its lows. You're like, holy shit, Nasdaq's up 20%. A lot of your names you're seeing up a lot more than that. But the S&P right now is still down 12% for the year. The Nasdaq is still down 18% for the year. That's how much we sold off. Now people are like, wow, things are still bad. We're probably going to be in a recession and we have inflation going crazy. And you saw those short positions and people go more net short, just going short. You might see a little bit more covering because, it's dangerous. If the Fed comes out in September and just is dead dovish, I don't know if they'll actually say I don't think they're going to say we're not raising rates because they just want to look because they got it so wrong in the past. They don't want to get it wrong this time. But they're going to say, hey, right now it's working. We're seeing inflation moderate, which is good. And we're also having a soft landing where we don't have to raise to the point where it's going to hurt the economy so much we do fall into a deep recession. If you don't agree we're in a recession now. But if that happens, it's going to be very tough to be short this market right now. You can be short certain sectors. Yes, that makes sense. But the overall market is going to go higher if the Fed is dovish September. And right now, looking at the next data and the readings, with energy being a big component, there's a good shot we are going to see inflation. Plus, with the interest rates, again, it's not like 1 month change, right? When it comes to inflation, you're seeing it moderate because what the Fed is doing is working. It's working, and it's going to continue to work. It's going to continue to be a drag on the economy to slow it down and pull, right? So think about, you're pulling something, right? If you're running and you got these ropes around you, you're holding someone back. You're not going to let them go. It's not like, oh, inflation, the ropes are still there. It's still slowing. That's what happens when you're raising interest rates. You're raising rates, you're slowing the economy down, and you're seeing it, and deleveraging in a lot of these sectors. However, you need to see it moderate. You don't want to see continue pulling, right? You continue pulling even harder, which means you're raising rates. Well, right now, what you're doing is working. You're starting to see that train where it's going downhill, you couldn't stop it. It's starting to slow, slow. And it should continue. This is the way it's worked in the past. It should continue to ease, which is going to make the Fed in a prime position to say, look, okay, we're doing our job. It's working right now. And let's see. And Powell's going to say, we're going to take a look at the data. But right now, we might hold rates steady for the rest of the year. And if they say that, the markets are probably at least 10% undervalued right now. Maybe we still finish down for the year. But you're going to see a nice comeback, even further than we come back since July. Now we look at sectors. And it's important to look at sectors, right? So who's going to benefit from this report? Banks. So a lot of times in the podcast, I say, well, this is what I said or whatever. Well, you know what? I was wrong on the banks. I told you to buy banks 6 months ago, and the whole entire market collapsed. I didn't think you see that much of a deleveraging that quickly. And I was wrong on that. But banks are in prime position. You might say, Frank, wait a minute. They benefit from higher rates, their net interest margins. But you're saying that the Fed could slow down. They're going to slow down. They're not going to reverse it. They're not going to reverse it and go to zero again. At least not for the next 12 to 18 months. 12 months, you could say. So they're benefiting right now. The net interest margins are incredibly high, right? They're skyrocketing. They're going to be over 30% from where they were last year. So, yeah, the Fed may slow the rate of rate hikes or say, hey, we're going to hold still at least for the next 6 months or so. That's great for the banks because now they're generating a ton of business, which that part of their industry sucked for such a long time. The interest margins were horrible at the lowest levels. You have interest rates low, but now they haven't really raised their rates on checking, savings, and things like that. But rates are going higher and higher where they lend money out, and they're making a lot more money. Plus, now you have the double benefit, not just from fees, well, not just from this part of the business and interest margin, interest rates, but fees, which was their bread and butter. But that kind of went away because the market collapsed so much. So you didn't see a lot of M&As. IPOs have been shelved. So, yeah, you said trading activity okay, but, for places like Goldman and stuff, I don't think Morgan Stanley's trading activity was as good. But now you're going to see both ends of this, where it's their fee structure and the interest rate structure, and you're hearing this from banks. They've been saying this for 6-9 months when interest rates go higher. They're like, we are in prime position. And they are in prime position. That's why they're raising their dividends. They're buying back stock because they're not really allowed to lend it all out because of crazy laws that still exist, which is nuts, but it ensures that our banks are in good standing. So you should own banks, even large ones. You can go a little bit more aggressive. You can get the JP Morgans and do well, nice dividend, and some of the bigger ones, and maybe, the top 4, whatever, as you research it in, but throw banks in your portfolio. If I get nice dividends, you're going to see strong growth. Earnings are going to explode going forward, but now you're taking kind of like that really deep recession off the table if you're sowing that interest rate hike. And that's going to be great. Where you're going to see M&A activity come back, IPOs come back that have been shelved over the past 6-9 months. And that's going to be great for a lot of these banks, investment banks, and a lot of these names. That's a sector that should benefit tremendously. Aggressive sectors that have gotten annihilated. Small caps, very aggressive with small caps. Cheapest they've ever been. Now this is great. And the dollar doesn't really hurt them, right? Because the dollar is good. Most of these companies, the small caps, they do business in the U.S. They don't do business overseas. So they don't get hurt as much. And that has been cheaper. Small caps compared to large caps have been cheaper than almost any time in well over a decade. Not to mention, if you're just looking from the price to growth perspective, it's never been cheaper other than last month. Still, it's at levels we haven't seen in my research dating back for 22 years. That's how much small caps sold off. So you have to look at how much these stocks sold off. You can't just look and say, well, I never looked at the small cap index. I have no idea what's going on, but I'm a little worried about the market. Well, if small caps only sold off 10% during this time frame, I'd say, well, you got to be careful. But they sold off 30, 35%. Some of these names are down 60, 70% in biotech. And you're looking at the technology companies, tech sector across the board, even large cap tech, have sold off tremendously. But you know what? Supply chains are easing. So start looking at companies that got hurt from supply chains, because the next 6 months or next 2 quarters, they're probably going to say, hey, they're easing now, and we have more predictability where even the car companies, when we get out more of these EVs now. More money with the chip bill that just passed. So chips companies, tech companies, and also semiconductor companies, 2 areas you should be looking at, as well as small caps, as well as crypto, where you saw Ethereum get murdered. And I've been telling you, 90% of crypto is BS, and it's nice to see this filter out because this is where all the innovation's coming from. DAO, Metaverse, NFTs, DeFi, this is where it's coming from. The innovation part is coming from. This is where everybody's going. This is where all the major technology companies are spending a ton of money. This is where innovation is coming. Got rid of a lot of the BS, but there's still 10% of this industry are great names that we've been researching. So we see Ethereum fall to 800. Ethereum's 1,800 today. It was 800 a month ago. Bitcoin, you've seen catch a bid. Now you're going to see all these institutions. You heard Fidelity come out and say, hey, we're going to offer 20% allocation to retirement accounts pretty soon. Be sure to listen to tomorrow's interview because it's a great interview about Bitcoin IRAs. Please listen to that. Give a little shout out. It's going to be a great interview tomorrow. But you're looking at Bitcoin, some of the good ones, some of the good names here. There's Avalanche and a couple others I won't mention, but we have a lot of good names on our portfolio that are starting to rebound sharply after selling off tremendously. Even the great names sold off tremendously because of deleveraging. Now you're going to see some of these names start bouncing back. You saw it already. Some of them are up 25%, 30%. Ford's up tremendously from its highs. If their supply chain eases, Ford is a great investment going forward. And I've been critical of them for a long time, all the way down, because CEO has been lying about the supply chain concerns and the fact that they're like, we're going 100% EVs, even though right now Ford came out and said, we can't make money on EVs. That's why they just raised the price of the F-150 Lightning. They just raised the price of it. Because they can't, right now, they're not making money on their EVs. That's how much the costs have been risen, batteries and everything across the board. So you have to sell more gas vehicles, and they're like, we're getting out of gas. No, you have to sell more gas vehicles, which they did last quarter, and you saw those numbers explode. So great sales for last month, Ford. So start looking at car companies. Start looking at names in the chip sector that have gotten hit hard. Because that's going to start easing right now. And now when you have the Fed saying, hey, you know what? We could put, again, it's 1 month of data, but it's positive. And usually when you see this, it's supposed to happen last month. I thought it happened last month where you saw easing. It's still relatively high. It's very high. But you want to see that trend coming down because it's going to result in the Fed being less aggressive. And that's the biggest risk of the market, of them raising too much, too high, and overshooting. And if they do that, that is the biggest risk of the market where you see stocks fall and you'll see bankruptcies, more deleveraging. But if they slow that pace right now, that's what the market's telling you. That's why we've seen a nice bounce. That's why we've seen a 10-year down to 1.7%. Sorry, 2.7%. We're seeing it down. It was over 3%. So what the 10 years telling us is that the Fed is going to slow and may say, look, you know what? 3% may be the top when it comes to the Fed funds rate. And it should be. At least at 3%, and let's see for a couple months what happens. And if it's not working as well, then we go high. But based on the data today, you have to be willing to change your mind and sell stocks. If we see inflation start rising tremendously next month, heading into September, and they go 50 basis points, 75 basis points, which I think 75 is crazy, and they say, hey, you know what? It's going higher. We got to get more aggressive. That's different. You change your mind. You change your portfolio. As of right now, stocks should continue moving higher because the Fed, which is the most important thing, right? The most powerful organization on the planet by far, is probably going to get dovish when it comes to September after they raise by 50 basis points, which is good news. So you're looking at small caps catching a bid. They've been catching a bid. Banks, technology, crypto, semiconductors. You're looking at losers. I would say energy, only because there's so much money that poured into that sector. And yes, $90 is an incredible number. when you're looking at oil prices. I mean, remember when they were like futures were pricing in zero not long ago? Is that like 18 months, 2 years ago? And we're looking at $40 good 50, then it went to 130, which is insane. But looking at stocks in general, and we've seen a lot of money coming out of these names over the past 6 weeks, they're still up tremendously over the past year, past 12 months. But when you look at institutional money, they go to what's working, and they poured into energy, which was what? The only thing that was working. Everything else was not working except for energy, basically. And just look at the S&P performance right now. Look at the yearly performance. You've seen how much oil companies come down and down 35% from their highs. There's still like 30 of the top 50 names are energy companies when you're looking at performance for the year. They're up tremendously. So now you're going to see rotation. That's what you're seeing. If other things are working, they're going to rotate out of that and go into some more. Now this is telling you, all right, the leveraging is probably going to ease a little bit. You see more money pour into some of these aggressive sectors that got annihilated. Like biotech has gotten annihilated. And the biggest funds, man, I don't know who's keeping track of those guys and how leveraged they were. But, man, the forced selling in that industry, I can't tell you how many great names in biotech were trading below cash. And these are companies generating revenue. I'm not talking about just, the speculative ones, putting all the eggs in one basket. And, hey, going into phase 2 right now. We have positive phase 1. If it doesn't work, it's going to go down 80%. If it does, it'll go up 500. I'm not talking about those names. Good names that have great partnerships that are generating revenue have gotten annihilated. That's a sector that topped in February. I'm talking about February 2021. Around there, February, March, and have consistently went down into November and then got annihilated when the Fed reversed course and said, hey, we have to raise rates. So this is very positive. This is something you should have been prepared for, been investing in a lot of new stocks. We're going to have more recommendations. If you're a Curzio Research Advisory newsletter subscriber, we usually publish on Wednesday, which is the second week. Just wanted to see these results first. So I don't know if they're going to come out tomorrow or Friday, but you're going to get either tomorrow or Friday. There's going to be at least 2 recommendations, likely 3 new recommendations in it. So I just had to finish up my research, which is great. But it was important to see this number because if you see another negative number of inflation still rising, you could have saw capitulation and people saying, all right, I'm throwing in the towel. Holy shit. Inflation is just, they can't control the Fed. It's crazy and they got to go to 4%. That would result in the markets. I mean, what you're seeing right now across the board with some of these stocks up 8%, 10%, they're shown on CNBC right now. They would be down 10, 15% right now if this number was bad. You would have seen a huge shift in capital to the other end instead of coming into the market. So now we see this. You can see lots of recommendations. A lot of names are still down 20, 30, 40% from their highs. Yes, they're up 20, 25% from their lows, but crazy buys. A lot of these companies have pricing power. You've seen insiders still buying at these levels, even though they're buying aggressively almost at a record pace 2 months ago. Now it's slow. You're seeing a little bit more sells and buys, but there's a lot of good names out there, especially large mid-cap, that you would buy and say, all right, I want an 8% return over the next year, annually, over the next couple of years. I mean, you could see 20% plus returns on some of these names on how far they've come back over the next 2 years, 3 years. And you might see that right away. You might see that later. But where they're trading right now, there's a lot of names I'm seeing that are screaming buys, and you're going to see them come out in my Curzio Research Advisory newsletter, which is a very affordable newsletter. It's almost like not a beginner newsletter, but it's focused on large caps, mid caps, good companies. It's not like Curzio Venture Opportunities where it's a lot of more research. Sometimes we put in microcaps in there where I'm the analyst providing all the research and they're looking at my stuff, my model and stuff. So, a lot of more research is dedicated to that in terms of some of these other large caps, mid caps that are covered by 20, 30 analysts sometimes. So it's a lot easier. So those newsletters are a little bit more expensive end, but Curzio Research Advisory is a very affordable newsletter. If you guys want in, just give me a shout, frankcurzioresearch.com. Again, it's extremely, extremely affordable. Less than what you would fill up your tank right now for gas for the year. That's a year subscription. So, that's me saying all new subscribers will come in. A lot of them come in at Curzio Research Advisory Dallas Stock Club. This way they see what we're about, right? That's when you subscribe to that, it's, hey, let me see what Curzio is about. And you're going to see a newsletter where I do 30-minute videos breaking down, showing my research, which is, sharing a lot of the sites that I pay a lot of money for and institutional research and showing why I recommend, really breaking it down, easy to learn. That's why I'm trying to educate you as well. But that's a great starter newsletter. If you guys are interested, let me know. Curzio Research Advisory. That's going to come out either tomorrow or Friday. I'm going to try to get out by tomorrow. Just doing a little research, finishing up. But you're going to see at least 2 recommendations, maybe 3 in the next newsletter, which is really cool because we're going to start getting aggressive because I think the Fed, what we're seeing right now, we're going to continue to see inflation to moderate going forward. And that's going to make the Fed much more dovish, which I think if they do, you have a lot more upside in this market, especially through year end. Let's see what happens. Markets are still down. I know they're up, and you're like, wow, it's come back. It's cool. I don't know. But remember, S&P still down 12%. NASDAQ still down 18%. Right? So there's a lot of names that are down more than that in those two indices. And those are names we're going to be focusing on, names that have been unfairly punished. And you're going to see separation in a lot of these industries, but you will see some recommendations, Curzio Research and Advisory. So, guys, that's it for me. Questions, comments, free to email me at frankcurzioresearch.com. I'll say it again. Be sure to tune in tomorrow to Bitcoin IRAs. It's really, really cool. You're seeing Fidelity. You're seeing BlackRock. You're seeing Coinbase. You see more and more money pour into crypto. And Bitcoin, Ethereum, offering this alternative asset class because clients want it. So JP Morgan did about face. You look at hedge funds doing about face, and you're going to see money start pouring into this. And here's a way, when it comes to Bitcoin IRAs, pretty cool. I don't get paid by this company or whatever, but they're going to show you how you can invest if you want a portion of your money in IRAs. This way you don't have to wait till Fidelity, BlackRock, or whoever, and State Street gets their approvals or whatever, and how long that takes. You can actually do it right now, and it's a safe way to do it. So it's a great interview tomorrow. Make sure you stay tuned and tune into that because this is a first-time guest, and it is a great interview. So I'll see you guys tomorrow. Take it easy.